Well, the property market has slowed quite substantially in the first half of 2023, and that's really due to the rapid rise in interest rates, which has caused significant pricing uncertainty for real estate. So we've had an extended period of very low interest rates, and that pushed a lot of capital into global real estate. But obviously, with a spike in inflation post-COVID, that situation is completely reversed. And that's caused lots of pricing uncertainty. And so initially that pricing uncertainty manifests itself in very low deal volumes. Our liquidity analysis shows price expectations between buyers and sellers have moved a long way apart. And so without that agreement on where pricing is in the market, you see a dramatic fall in transaction volumes, and that's really where we are at the moment. The outlook really depends on the actions of central bankers. Central bankers were the architects of the last property boom as they kept interest rates exceptionally low for an extended period of time. And I think when the rate cycle does peak and we're at the terminal rate, I think that will provide some certainty to investors. And so some certainty around the trajectory of interest rates and around where pricing should be in the real estate market would allow the deals market to open up again. I'm not sure we can expect that in Q1 of next year. I think it's going to be maybe 6 to 12 months before we see the transaction market really open up. We are seeing a little bit of a rebound in parts of the market where we've seen the most rapid correction, so parts of the industrial sector across Europe where you've had a rapid repricing and rents are still growing. That's pulling capital back into the market, but there are other sectors where the deal volumes still are very slow. It's clearly difficult for investors of many stripes to do deals at the moment, and you can see that just with the low transaction volumes. Some of the major US institutional investment managers who've already raised significant amounts of capital looking at opportunistic investments, they've been active in the market in the first half of the year. Some sovereign wealth capital as well, coming from the Middle East and the Asia Pacific region as well, has also been active. A little bit of private wealth as well, active in some parts of the market. And also capital coming out of Japan. The Bank of Japan have not increased interest rates in the same way that we've seen across many other developed economies. And so we're seeing some of the capital that, coming out of Japan and being deployed in global property markets at a level we actually haven't seen before.